Now some helpful tax tips from the offices of Manjit Singh CPA PC.
Folks, good morning. This is Manjit Singh. Last week we talked about the 10 ways not to avoid your tax return being audited. And since it's the beginning of the tax season, and Kusum and I both felt that this would be the appropriate time. So today I'm going to ask Kusum some questions, since I did most of the talking last week. Kusum, one of the points that the Wall Street Journal made is avoid claiming deductions that are red flags.
Yes. And time again, it seems to me like the business use of home form is the one that attracts a lot of attention. And with good reason, because a lot of people who don't exclusively use their home for business do go ahead and decide that it's a good tax deduction to take, and therefore they fill out the form, claim the business use of home deduction, and claim part of their utilities, their insurance, their homeowners dues, their landscaping, just about everything that they can think of, including the air they breathe, and apply a business percentage to it and deduct it. And for that reason, it's popular. Having said that, I should say that proper record keeping will get you past that as well. So if you have an exclusive area in your home that you are using for nothing other than business, if you have a couch in there and a TV and you're watching, then that's not exclusive use. So it has to strictly be an office, and then the IRS will accept that that's what that is. But that is one of the forms to really be careful with when you claim that deduction.
The next form is pay attention, not the form, but the next item to be concerned about is pay attention to the details.
Which is very, very important. You must pay great attention to detail because you file only one tax return each year, and it had better be accurate and detail oriented. And if you have dotted all your I's and crossed all your T's, there isn't that much to worry about. But if you have not, if you've left loose ends, if you haven't filled out the mileage for your automobile usage, things like that are going to attract attention.
There is also a myth that in the past, the Journal Accounting Office, which is now called the Office of Accountability, used to release statistics that, let's say, this income level individuals have claimed this much, and they used to give absolute amount of charitable donations or expense amounts given. Is that still true?
Well, they still do maintain statistics, but really there isn't. If you have your receipts, in other words, then you have nothing to worry about. But if you don't, you do have to worry about it. And therefore, I would never take a deduction that I didn't feel that I was 100% entitled to. And I'm not saying this because I am a professional, but there is no substitute for good professional as far as your taxes are concerned. The other thing one might want to do is also change the type of entity, because statistics prove that sole proprietors are more likely to be targets of IRS audits than are shareholders of an S corporation.
Strange you should bring that up. Shareholders of an S corporation. Okay. Yes. In the past 2 years, I have been reading about that people who have sole proprietorship businesses are claiming extra expenses on their tax returns because it's a double effect. You're saving on the Social Security tax and the Medicare tax, and then at the same time you're saving on the income tax. One of the strategies that has been applied in the past is to distract attention is to move your Schedule C business into an entity form like a S corporation or a limited liability S corporation. However, having said that, please be aware that the first thing the IRS has done in the past, first they tried to have Congress pass a law that the profits on a K-1 be subject to Social Security and Medicare taxes as well. Luckily, it didn't go through. People who would have been affected are professionals like CPAs, attorneys, physicians, and IT professionals, especially those who have only one contract or two contracts. It didn't pass through. The other aspect, the second part of the aspect, and this news came out only just about a week ago, a CPA who had claimed only $24,000 in W-2 versus $200,000 on a K-1 profit was taken to court, and the court decided in favor of the IRS that a reasonable salary needs to be taken, and $24,000 is not a reasonable salary for a CPA who could be making about $100,000 to $125,000. So folks, yes, it is true that you can look at these things, but be careful, it's still there. Having said this, I think we would like to wrap this program, this segment up today.
With saying, in any event, prepare for an audit by keeping all your receipts for a period of at least 5 years from the time you file your tax return. And with that, we wrap up this segment. Thanks for watching.